Some investment questions need answers. Today is the day. Hello guys, this is Chuka once again. Welcome to my YouTube video where we talk about investment. Also let you into some investment decisions. My business here is just open your eyes to investment opportunities, but the choice is yours. Alright, so guys, I have quite a number of questions from the last few videos, and today we'll be answering some of these questions. So let me start with number one question. It says, what are the current trends shaping the investment banking industry, and how should investors position themselves to benefit from them? When you talk about the investment banking industry, generally we are talking about the economy, right? So in my last video I talked about knowing what government strategies, focus, economic outlooks are. So when you have this information, then you're better positioned to tap into what investment you should look out for. But at the top of my head, I reckon that the government will be borrowing about 13.3 trillion from the fixed income market. And what does that tell me as a trader and as an investor is that this yield level we maintain. We have a high yield regime. Currently 1 year is around treasury bills, right? It's at 23%, right? So what other business can you do without stressing yourself that earns you 23% in a year? I think these are some of the questions that you need to ask yourself, right? So for me, I would say, look, just invest in 1 year T-bills. Why? Because as long as government is looking to borrow heavily, as long as the economy remains the way it is, and then the CBN governor's strategy, which he hasn't changed now, is price stability. As long as he's going to continue to maintain price stability, which obviously is helping him to fight the inflation, that does not mean that there are not other investments you can do, but of course you need to weigh. But for me, my advice is for someone who has a lot of things he or she is doing, you don't want to stress yourself about worrying about your investment. Just put your money in T-bills, 1 year bill, 6 months, 3 months, they work for you. So let's look at the second question. How do you assess the risk reward profit of an investment or deal? So my previous video, we talked about risk, and I said there can never be an investment without risk. There can't be human existence without risk. Everything you do, from drinking, simple things as drinking water, also has its own risk. There are times when people drink water and they choke, right? But this is something that we just do. Take a bottle of water, a glass of water, and you take it as if nothing happened. So also, the higher the risk, the higher the reward. But again, for me, you also need to weigh your risks. That's one of the fundamental aspects of going into investment. You have to have your risk appetite top notch. So you look at, okay, if I want to invest in agri products, for example, what is the risk? If I want to invest in fixed income, what is the risk? If I want to invest in real estate, what is the risk? So you have to measure your risk parameter as well as your risk appetite, because the risk appetite for Chuka might not be the same risk appetite for Mr. Adewale. Two different things. And so that was why we talked about investment for those in the 20, 30 and 40s, because within this age bracket you are more risk adverse. You have, you can take more risks. Many of the folks in 20s, for example, especially guys, are not married, so you can take more risks. It is something that you need to look out for. Weigh your risks, do your own templates, ensure that the risk appetite you have is within your structure. And that's why I said be intentional in your investment. I keep saying this word because that is the primary aim of being an investor. You have to be intentional. So let's look at another question. So he said, what strategy do you recommend for individual investors to diversify their portfolios effectively? I always advocate that, look, you do not concentrate your investment in one place. Just the same normal saying, I say, look, do not put all your eggs in one basket. So I like to diversify. And that is why the practical example is most wealthy investors. You see that they have multiple streams of income. They don't concentrate their investment in a particular area. Why? Because in as much as you want to make a lot of money, you do not want to concentrate your investment, your cash flow in a particular sector. Take for example, you have people who invest in oil and gas. At the same time, their number one profession is banking industry. You have people who are in aviation but also have real estate business. The idea is spread your wealth. Do not concentrate your wealth in a particular field, so that when the real estate business is not moving, equity business is moving. When equity business is not moving, oil and gas business is moving. When oil and gas business is not moving, hospitality business is moving. So you do not have to concentrate your investment in a particular area. Diversification, it's a way of not just only ensuring investment security, but also helps you to also maximize your earnings, your profitability, and safeguard your investment. So we take this final question. What advice do you give to someone just starting their investment journey, particularly in a volatile market? Awesome. I love this particular question. There are things that you need to look out for. There are some businesses that even though you have the capital, if you invest, okay, let me put it this way. So if you want to invest or you want to start up a business, one of the fundamental things you need to look out for is you have to do your due diligence. When I mean due diligence, I mean check the area, scan the area. For example, you want to set up a world-class lounge in an average area. Right, so you've got all the good things, all the structure, everything that you need. But the problem is, if what is obtainable within that area is not in line with what you're bringing, you find out that you will not make much progress. So you might have a beautiful product, but in the wrong environment. So you have got to do your homework. You have to be sure that the environment I'm coming in, what customers will I expect to have. When I was in sales, we used to segment our customers into customer A, customer B, and customer C. So customer A are the super rich customers. They really give stress because, in the banking industry, some of these customers probably they don't even come to banking hall, right? So they come maybe like once in a year, or probably just put a phone call. So you have, and these are the guys who have trillions or billions in their account. So we have customer B. These are not the same categories as the customer A, but very super rich customers who probably come maybe twice a year or 3 times a year. All right, they also have some. But then you have customer C, and these are the average customers. And we used to make joke then that, look, these are customers that before the office opens, they're already right in front of the gate, and these are customers that have maybe like less than 5,000 in their account, and then they withdraw maybe like 4,900. So you have got to segment your business, the target customers. This way, you're able to know the right product you're going to sell, you're able to know the right investment you're going to make, and most importantly, you're able to ensure that your investment is not wasted. You don't get into an investment that you spend so much money but with little return. Basically, I want to thank those who have sent out some of these questions. There are other questions that we'll be looking at in our subsequent edition. So ensure that you subscribe to our YouTube channel, follow us, and stay tuned for more videos. So thank you very much once again, and then see you soon. Thank you.